honored to have with us today Graham Corporation. And with us today we'll have CEO Matt Malone and CFO Chris Thome. Graham Corporation is based in Batavia, New York, designs and manufactures fluid, power, heat transfer, and vacuum technologies for the defense and space, chemical and petrochemical, processing, petroleum refining, cryogenic, and energy industries. Graham has 11 million shares, trades at $47 for a $530 million market cap, 11 million of net cash for a $515 million enterprise value. I think we'll have a short presentation, and then we'll follow it up with Q&A. Okay.
Perfect. Thank you so much for having us again. It's year 3, and I'm excited to start off with, it's been an evolving story over those 3 years, so I think you'll get a glimpse of what it looks like today. So Graham Corporation was founded in 1936, so it's been a 90-year business. And over those 90 years, it's been primarily in the energy and process side of the area. So what we have done is provide vacuum systems for critical refineries, petrochemical, and a whole bunch of other applications. So think of a distillation tower where you're actually drawing the main vacuum. Graham has provided that equipment for 90 years. Why that's relevant is because over those 90 years, we've developed almost $1 billion install base around the world. And that $1 billion install base had for a long time allowed Graham to ride the cycles. But today, we've diversified the business to be 60% defense. And with that diversification, it allows for a really stable platform business. And so we have $500 million-ish of backlog, which allows us to make really long-standing investments in the business that then we can use things like automated welding on the energy and process side as well and extract value in both locations. In addition to that, we have entered through the acquisition of Barber-Nichols, which is the business that I come from, into the space business. And so it's about 10% of our revenue. But what we're seeing in that business is launch capability is really proliferating. So we're seeing a lot of launch capability go to market, and we have critical rotating machines that provide the fuel to the rockets, that allow for cryogenic recirculation and many other things. In addition to that, where our growth area that we're seeing is we've been investing quite a bit in testing. And so in the testing, now we're able to offer a full value lifecycle product to our end user. And so they can just essentially plug it and play it into critical applications. Those things, for example, are the rocket turbopumps that provide the fuel to the rocket launch business, the oxygen fan for astronaut backpack, so we're manufacturing it, and then many cryogenic recirculations for tanks and in-space propulsion. What's most interesting is on the defense side, as we've pivoted to a 50-50 commercial defense business, it really has allowed us, once again, that stability. And so we've been making 20% or greater ROIC investments back in the business. So recently, we just announced a large addition to the Navy facility. And that has just come online within the last month. And so we have all fully automated welders, as well as inspection equipment sort of ready to deploy in that facility. So what we're doing is we're bringing automation to that segment, which hasn't been there for a while. All of the programs that we're on, so when we talk defense and nuclear, think about the main condenser that does all of the thermal management for the submarine or for the aircraft carrier. That's what Graham provides. And so 80% of our defense work is sole sourced and allows us to actually think long term out through 2056. Okay. In addition to that, another asset that we have on the submarine is what's called the air turbine pump. And that is what launches the torpedo out of the front of the submarine. And then in addition to that, the thing that goes in the torpedo tube is... Okay. I'll go to one slide, and it will be I'll just sit there. I know. How do I... slide that I was expecting isn't in there. Okay, so back to the story. What's interesting about the business is when you look at like the condenser that goes into the submarine or the aircraft carrier, while that is a platform and those have many, many decades of longevity, we are also in some small call areas. And so what I mean by that is we have the big legacy platforms that have a lot of longevity, and then we have new up and coming platforms like military aircraft for providing cooling for critical systems. For defense, for directed energy and laser systems and radar systems, we're providing critical cooling platforms for next generation product. In the energy and process, I talked about the vacuum and heat transfer systems, which have been in the Graham portfolio for 90 years. With the Barber-Nichols addition, we're actually bringing into the portfolio quite a few helium circulators and molten salt pumps for small modular nuclear, which we're on scale-up programs for. In addition, we're working on cryogenics and cooling systems for data centers. And then lastly, in that platform, we're working on quite a bit of hydrogen and transportation and pumping systems. So the reason I wanted to go through that is with the Graham portfolio, you sort of get the known incumbent, sole-sourced, long, multi-decade platforms in addition to some small calls into some exciting markets. Where I wanted to go next, and I'll sort of finish here and then open up for questions. We went through what's called a stabilized phase. And when Graham acquired Barber-Nichols, we did go through a situation where there was no cash left in the business. We had to sort of reset our 5-year plan. At that time, myself, Chris, and Dan Thorne, our previous president and CEO, really took over and joined the business. And the 3-year stabilized phase, we've met, all of our guidance. We've been growing the business back. We've tripled the backlog. We've taken the EBITDA margins from -3% to roughly 11% EBITDA margins. And in addition to that, we've diversified the portfolio from almost exclusively energy and process to 60% defense. So the stabilized phase has really been a great foundation for the corporation, but we're only in inning 2 out of a 9-inning game. And the improved phase and the growth phase is what we're, moving to now. And so if you look at the improved phase, a lot of folks are saying, what is the improved phase? Well, over the last 3 years, we've been making a ton of capital investments in the business because they've been underserved for multi-decades. And what those look like is, as I mentioned, a new Navy facility that's 30,000 square feet, a new overhaul facility in Navy, a large cryogenic test stand down in Jupiter, Florida to test our product and ensure it's validated. And, oh, by the way, our customers are coming to us to use that facility on a regular basis. So we're making these investments in new ERPs and all these other things, and we really want to make sure that all the hard work we've done in capital investment and R&D, that we see through the value phase of those in the improve. While we're doing the improve phase, we're working on what's 2 to 5 years out, which is the growth phase. And really what the growth phase is hunkered around is we've been creating products at Graham, Barber-Nichols, and the rest of the portfolio for 60 or 90 years. That's the respective business ages. And they have all been one solution for one final application. So what I mean by that is think of one cryogenic pump that goes on one trailer for one customer. And we have a list of 20 to 30 products that have done just that. In many cases, we own all the IP, we have all the know-how, and so what we're doing now is we're taking a more holistic approach where we're going to market, essentially commercializing those products for a larger reach. And so we're going through that phase right now. And then in addition, I mentioned the service and aftermarket. Graham has $1 billion of installed product. Today, it's a pick-up-the-phone model, which means our customer calls us and says, I see your brand, I need your product again. That's not an efficient model, really, and so we're actually going to a proactive model. We know our entire install base. We know the exact pedigree of the equipment, so we're working to go to them with a preventative maintenance plan. So it's an exciting time. The last thing I will say, and this has been one that I've sort of hashed over and over, the innovation arm of Graham was really in a bad spot. It was about 50 years of just distributing the same product. We have been utilizing the R&D center is fully back up and operational. We've had 7 training courses with all of our customers on academics to train them on vacuum systems. And in addition, we're creating the next products. And one of the examples of that is we're actually using P3, one of our businesses in Florida, to do all the computational fluid dynamics, which is basically advanced analytics, to reinvent the parent business vacuum systems. And so we're starting to see the synergies really unfold, but we're in the early phases. The last thing I'll talk to is we laid out a 5-year plan 3.5 years ago, and at the time, it was hard to stand behind. I mean, really, you were sitting here. And Mario, I know you were in the audience when we said it, but we said that we would get to be a 15%, or I would say low to mid-teens EBITDA business, and we'd be a $200+ million business. And over the last 3 years, we've marched to that plan exactly, if not a little bit ahead. And so we've got a year sort of left of this plan, and we're really excited of where we're at. Where we're at right now is, we're in the low teens EBITDA, but we actually, as part of the acquisition of Barber-Nichols, created a bonus program for the employees. So myself and the other owners created a bonus program that has to run through the P&L. So that's a 200 basis point hit on the lift. So we're pretty close to the low to mid-teens is the takeaway, and the revenue side's growing nicely. So we're well on track to our plan. We think the fiscal year 27 targets that are shown here are absolutely achievable. We think we're on pace for them, and we're already laying the foundation for the growth phase thereafter. So long-winded, sorry for the presentation hiccup, but off we go.
It's great. That's a great overview, Matt, and congratulations on all your success. Thank you for all your hard work here for Graham as well as Dan. Maybe you talked about 60 to 90 years of sort of compounded knowledge and in this industry. The key markets that you serve. What makes you guys a leader? What differentiates your business versus everyone else, and you get so much win?
Yeah, so two things. When you think vacuum and heat transfer, which is really the Graham core business, every single solution has a very unique end application, and through that, there's essentially condensables that are in the flow, and so it's something that is quite technical in nature to analyze, and so you actually have to use empirical data, and so we've built homegrown tool sets that do that empirical lookup, and so we're able to really advance the performance based on years of pedigree. In addition, now we're starting to root that in, advanced analytics, and so we're even pushing the ball further. So it's a set of tool sets, IP, in that side of the business. In the turbo machinery side of the business, it really is just long pedigree of doing challenging things. And I know that sounds probably redundant, but when you're talking rotating machines, we launched SpaceX's turbo machines. It's sort of published to space, and they've gone up many times successfully. And so you sort of get this pedigree of being successful, of getting to space, for example, and it becomes sort of a known path from there. And then now we're using that space pedigree in the small modular nuclear reactor. We're working on, I'd say, a handful or more different programs, and it's because we know hot gases, and we know nuclear, and we know rotating machines, and you put the three things together, and we're really well fit to provide the critical machines.
That's very interesting. It's almost like the sort of the neural network in a pump and vacuum and heat transfer view. Digging deeper into the U.S. Navy opportunity, what do you see in terms of future growth based on planned shipbuilding programs? It looks like it's essentially unconstrained demand there for the foreseeable future. And how is the current administration viewed shipbuilding? You could talk a little bit more about that.
Yeah, I think there's no doubt that everyone sees the momentum behind shipbuilding. And what I'll say is, we're feeling it. The reality is 3 years ago, we were behind schedule on a critical strategic program. Today, we're actually ahead. And so it's a great place to be. What that has allowed us to do is we've gotten close to $20 million of grants from our customers to reinvest in our business and continue to move forward and be well positioned to take on additional work. So being on time and on quality has allowed us to have conversations about what the next program opportunities is. We actually have line of sight with the automated welding and the ability to attract talent. We are not welder deficient. We're in upstate New York where there's welder talent, and we've been creating a program with BOCES to bring them. So we've actually been able to attract close to 30 trained welders a year. And so we've sort of tackled some of the bottlenecks that are holding the shipbuilding back. And so the short takeaway is we see runway with the current scope that we have, and we're starting to see our ability to execute on those programs translate into what could be the next programs.
Wow, it's pretty cool stuff. As far as energy, there's been talk of a slowdown on the energy side. What are you seeing thus far, and what percentage of revenue is this of your portfolio? You know, and how did the company perform in previous industrial recessions? Are you seeing anything like that?
Yeah, so interesting comment. I think folks are sort of saying energy slowdown. I think the demand in energy, the need for energy is high. I mean, we're talking data centers. You see Meta buying up. You see nuclear coming back on the grid. So I think the energy demand is actually quite high. I think it's what does the diversification approach to supply the energy is really the question. In our business specifically, I'll just kind of run through the portfolio. Aftermarket, super strong. We have a $1 billion install base. Plants are operating sort of lights out or looking for more capacity. In the international side, India was at a little bit of a slowdown along with China, and the reasons for that were just a lot of geopolitical tensions and just some uncertainty in the market. We're starting to see those programs move forward again. So they were slow, they weren't being canceled, and we're seeing them pick up again. On the U.S. major side, which we sort of say is new facilities, it is absolutely slow. There's no doubt. With that being said, we're seeing projects eventually break free. And so what we're focused on is accelerating the aftermarket because we have a $1 billion install base and we're picking up the phone today. We're bringing new technology to improve efficiency, so essentially modernizing or upscaling our existing install fleet to bring more value to the customer. And then, we're looking internationally really strong. So, we have offices in India and China, and we have a strong foothold in those markets. And so we're taking advantage of the growth in those markets. And then that's the conventional side. Small modular nuclear data centers with cooling, I mean, those are just in their early phases, but we think we're well positioned to ride those tailwinds.
And I guess on top of that, let's keep going there with SMRs. Specifically to you guys, what are the opportunities that you are seeing there? Where are you going to play in the SMR role?
So it will be interesting to see how it unfolds. I'd say there's two areas that I'm most excited about. The first area is utilizing conventional Graham core fabrication for just large commercial nuclear. And that's things like the main reactor. We have the opportunity, we've had our N stamp, we can, recertify and get back into that business if we so decide. The other is in the small modular nuclear side where size really matters. And in the nuclear presence, that hasn't been the case to date. And so when you talk about deploying a small modular nuclear canister, let's say, to a remote location, it needs to fit in a vessel. And size really does matter then. And so as you look at the size, power density, how much can you fit in a package, you need advanced rotating machines. And so really the takeaway that I see is our primary play is going to be advanced rotating machines, which passively manages and regulates the temperature of the reactor. And then secondarily may convert the heat source to an electrical source. So I think that's our two areas. And then the secondary play would be just commercial fabrication on the commercial nuclear side.
We've discussed margin expansion. You've done a great job. Maybe you could talk a little bit about what initiatives you have in progress currently and how those tie into the 2027 goals, and you could talk more about that.
Yeah, sure. Thanks, Tony. I could take that one. So as you can see on the slide that's up here, we've made some really nice progress improving our adjusted EBITDA margins from 7% to 10% to 11% at the midpoint of our guidance this year. But we still have a little ways to go to get to our low to mid-teen adjusted EBITDA margin guidance for fiscal year 2027, which we are a March 31st year end, so fiscal year 2027 is less than a year away, so not too far away. Matt already mentioned, the Barber-Nichols earnout bonus, which is going to go away after this fiscal year, so that immediately gives us 200 basis point lift there. Matt also spoke a little bit earlier that you can see on this slide. Right, we invested $20 million into our business last year, another $15 to $18 million this year. And all those projects, as Matt mentioned, had a greater than 20% ROI. And currently, none of those initiatives are impacting our P&L today, right? So those are going to start to come online in the next 6 months plus. And it's things like the new Navy facility in Batavia, which is filled with 6 state-of-the-art automated welding machines. It's the new X-ray facility that we're building in Batavia. It's the cryogenic testing facility that Matt mentioned earlier. It's all those things that's going to get us over that that last hump. And to give a little bit of an example, the X-ray facility expansion, right? That's something that we received a $2.2 million grant from one of our customers to expand our X-ray capabilities. Because if you think about the condensers that we're making, right, they're going in the hull of a ship and they do not come out, so they can't fail. So nearly all of the welds and all the critical welds for sure have to get X-rayed. Well, the process, one of these units, right, if you can imagine, is 15 feet high by 15 feet wide and weighs 200,000 pounds, right? So to X-ray one of these pieces of equipment took up to 3 days, right? And you'd have failed shots or you'd have to go and retake it. Right now, with this new facility, when it comes online at the end of the year, we think that's going to take us 3 hours. So that's just one example of the efficiencies, and it's the same thing with the automated welding equipment. We're seeing the same type of improvements. So that's really what's going to drive the margin expansion in 2027 and beyond.
That's great. That's great, Chris. Thank you. For orders and backlog, you've seen some large orders coming recently. Could you discuss order trends and what you're seeing in terms of customer decision making and your expectations for backlog conversion to revenue in the coming quarters?
Sure. So Matt talked a little bit about the markets already. Aftermarket remains strong. Defense business, as you know, has tremendous tailwinds behind it. The energy and process, large capital projects is slowing a little bit, but they're not going away. They're just kind of in this market of uncertainty, just aren't moving forward until I think people have a little bit of clarity on where that's headed. You're right, the first quarter we had record orders, 2.3 book-to-bill ratio, which drove record backlog of $483 million. Q2 was off to a good start we announced a month ago a follow-on order for 25 million Mark 48 alternators and regulators. So we continue to see strong orders. The pipeline remains strong. Record backlog. You can't complain about that.
Not a bad place to be. I'll ask about capital allocation. How are you prioritizing your capital allocation between organic growth and M&A? How do you guys look at that?
Yeah, so certainly the most profitable and the least risky type of capital allocation is organic growth. So that's kind of where we're focused right now. And when we laid out our strategic plan 3.5 years ago, it called for 8 to 10% revenue growth, organic revenue growth per year, and we've been able to achieve that. So first and foremost is always going to be organic growth. And as we've been talking about, all of the opportunities that we are investing in have greater than a 20% ROI opportunity. So that's going to be our number one capital allocation. With that said, we have publicly come out and said that we want to do M&A. M&A is part of our long-term strategic plan. But the nice thing about having the 8 to 10% annual organic growth is that we could be more strategic and opportunistic with our acquisitions. We don't need to do acquisitions just to grow. But first and foremost, organic opportunity, organic growth supplemented by M&A.
Maybe I'll open it up to the audience for questions. There you go.
Gotta do it. Okay, I'm doing an SMR. I got X number of megawatts or gigawatts. What's your content?
Yeah.
Do you define it in dollar terms as to if you sold everything that you're qualified to sell per either gigawatt or megawatt?
I can't put it in those bases.
No, that's fine. Whatever.
But what I can do is on a per unit basis for a small modular nuclear machine, it's somewhere greater than $1 million and less than 10 million.
And how much would that machine cost me? That's 1 to 10. Your content is 1 to 10 million. How much would that machine cost installed, the SMR?
That's the range I was giving.
No, that's what you're giving.
Our opportunity for pricing is 1 to 10 million.
Right.
And the follow-on question?
No, it was just a simple analysis to what percentage of this cost of the SMR?
Yeah.
So, is the SMR?
Yeah, so it's probably in the order of 10 to 25% of the entire unit. It's not insignificant. The reason being is we're talking about the main helium circulator for a small modular nuclear reactor, or the supercritical tube machine that converts the mechanical to electrical power. These are systems that are not insignificant scope. What I will say is, on each system, they're quite a bit different. So if you look at a molten salt solution, there's a pump and a heat exchanger, and so those are the type of equipment we have on those. If it's on a liquid nitrogen loop, then we have the liquid nitrogen, or the gaseous nitrogen circulator. So it really depends on the actual system, Mario, but the reality is like the turbo pumps we used to do for a launch vehicle, it's a really core part of the SMR.
Well, I can ask a couple more here. You know, Chris, you mentioned M&A at the end, and maybe I can throw it back to Matt for M&A. If you know, organic, maybe you don't have as much organic opportunities. Are there things? I mean, you know, it seems like this must be a very, a very lucrative industry. I assume there's a lot of demand for M&A here.
Yeah, so fortunately the pipeline's really strong on the M&A side. Myself and Dan have been working it for 3+ years. It's been kind of going on in the background for quite some time. With that being said, you know, we are looking for between a $10 and $80 million acquisition, so we've been pretty open about the criteria. The reason why is we really don't want to go back into the stabilized phase. We really want to use it as an additional platform to move forward. The two areas that we've been focused on have been, one, advanced technology that really moves our portfolio forward, as opposed to do it through R&D. The other area that we've been focused on is engineered product that really boosts our portfolio and really leverages our brand name. Both of those are going quite well. And what I'll say is, you know, we're having fruitful conversations, and our focus is on running the businesses, but these are nice additions. The plan that we have doesn't include any M&A, so it's all organic growth, and so it would be a nice opportunity to you know, continue to bolster what's already been presented.
Well, that's a wonderful overview, Matt and Chris. Thank you for being here today, and love having you at our conference, and hope to get you back next year. Great
Thank
job.
you, Tony.
Thank you.
Pleasure.
Thank you.
Tony Bancroft is a portfolio manager for Gabelli Commercial Aerospace and Defense ETF. Michael Bergio and Daniel Gleam are research analysts at Gabelli Funds. The above webcast is a recording from the 31st Annual Gabelli Aerospace and Defense Symposium, which occurred on September 4, 2025. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of June 30, 2025, affiliates of GAMCO Investors Incorporated beneficially owned 5.61% of Abdu Komen, 2.98% of Graham Corporation, 2.41% of Astrotics Class A and less than 1% of Class B, 2.37% of Moog Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921 5118 info@gabelli.com. Tony Bancroft is a portfolio manager for the Gabelli Commercial Aerospace and Defense Fund. This ETF is different from traditional ETFs. Unlike traditional ETFs, this ETF will not tell the public what assets they hold each day. This may create additional risks for your investment. For example, you may have to pay more money to trade the ETF's shares. This ETF will provide less information to traders, who tend to charge more for trades when they have less information. The price you pay to buy ETF shares on an exchange may not match the value of the ETF's portfolio. The same is true when you sell shares. These price differences may be greater for this ETF compared to other ETFs because it provides less information to traders. These additional risks may be even greater in bad or uncertain market conditions. The differences between this ETF and other ETFs may also have advantages. By keeping certain information about the ETF secret, this ETF may face less risk that other traders can predict or copy its investment strategy. This may improve the ETF's performance if other traders are able to copy or predict an ETF's investment strategy. However, this may hurt the ETF's performance. For additional information regarding the unique attributes and risks of this ETF, see the Non-Transparent Exchange Traded Fund (ETF) Structure Risk, Early Close/Trading Halt Risk, and Authorized Participant and AP Representative Concentration Risk in the Principal Risks section of the prospectus. Exchange-traded funds (ETFs) are bought and sold through exchanges trading at market price, not NAV, and are not individually redeemed from the fund. Shares may trade at a premium or a discount to their NAV in the secondary market. There is no guarantee the investment strategy will be successful. Investing involves risk, including the possible loss of principal. Premiums or discounts are the differences, expressed as a percentage, between the NAV and market price of an ETF on a given day, generally at the time the NAV is calculated. A premium is the amount an ETF is trading above the reported NAV, expressed as a percentage of the NAV. A discount is the amount an ETF is trading below the reported NAV, expressed as a percentage of the NAV. The prospectus/registration statement shows the frequency of distributions of premiums and discounts for these ETFs for the most recently completed fiscal calendar year and all completed quarters of the current fiscal year. Investors should carefully consider the investment objectives, risks, charges, and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes. As of June 30, 2025, the common stocks of Boeing, Ducommun, Curtiss-Wright, Moog, 5.55%, 4.54%, 4.26%, 3.69% of the fund's net assets, respectively. As of June 30, 2025, affiliates of Gamco Investors Incorporated beneficially owned 5.61% of Ducommun, 2.98% of Graham Corporation, 2.41% of Astronics Class A and less than 1% of Class B, 2.37% of Moog, Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. Distributed by G. Distributors, LLC, a registered broker-dealer and member of FINRA.